Okay. So tell me, accounts are of how many types? How
There are
many
two
types
types.
of accounts do you have?
There are two types, personal and impersonal.
In personal account, what is there? And in impersonal account, what is there?
In personal accounts, there is like all living people, like the names of the people, the debtors, the customers, the suppliers, and the creditors. And in personal account, there is like there are two types. There's real account and there's nominal account. Real account is like basically it's mostly non-current assets. It's the basic definition of it is things that you can see, you can feel, you can touch. For example, like fixtures and fittings, premises, banks, buildings and cash and machinery as well. A nominal account, it's about expenses, losses, and income and gains. For example, like bad debts, depreciation, discount, allowed discount, receipt, profit on sale, loss on sale, income statement. But and any of these have golden rules. The golden rule of nominal accounts, our golden rule is for nominal accounts is debit all expenses and losses and credit all income and gain.
For real
And
account,
for real accounts, the golden rule is debit what comes in and credit what goes out. And for real accounts,
personal
golden
account.
rule, yeah, for personal accounts, the golden rule is debit the receiver and credit the giver.
Okay. Whenever there is word goods involved, we use four
Mhm.
things. What are the four words that we use for transaction related to goods?
Purchase, sales, purchase return, sales
So,
return.
can somebody give me the journal entry for purchases? Cash purchases.
Purchase, okay, so purchase, purchase debit, cash credit.
Okay. Can somebody give me the journal entry for credit purchases?
Purchase, debit, trade, trade, payable, credit.
Okay. Somebody give me the journal entry for sales, cash sales.
Credit, cash, debit.
What?
Debit,
Sales, credit, cash, debit.
Okay. And for credit sales?
Sales, credit, trade, receivable, debit.
So under any circumstances, sales will always be credited, right?
Yeah.
yep.
Okay. Can someone give me journal entry for purchase, return?
So sales debit, purchase return, credit.
No,
Uh,
purchase, return.
Credit, cash, debit.
Okay, purchase is an expense, so it is always debit. Purchase return will be credit. So if
Hmm.
it's a purchase return will be credit, and what will be debited?
Cash.
No, your trade payables will be debited. Okay.
Okay.
Can someone give me journal entry for sales return?
Sales return, debit, trade receivables, credit.
Sales return debit, trade receivables credit. Lovely. Now, along with this, I want extra 4 journal entries. First journal entry is for bad debts. What is the journal entry for bad debts or irrecoverable
Bad debts.
debts?
Bad debts are debited and trade receivables are
Trade
credited.
receive.
Okay. What is the journal entry to transfer the bad debts to income statement?
Income
It's
Income
gonna be
statement,
your income statement debit and
bad debts, credit.
yeah, bad debts credit.
What is the journal entry for increasing or creating a provision?
Or creating the provision. It's gonna be the same one, is it? Like
Yeah.
in bad debts debit, trade
No.
receivable credit. Income statement debit, bad debts credit.
The journal entry to increase or create the provisions would be income statement debit.
Yeah,
And what?
bad debts credit. Bad
No.
debts credit.
No.
PDD credit.
PDD credit. The journal
Okay,
entry
PDD.
to increase or create provisions is income statement debit, PDD credit. What will be the
Yes.
journal entry to decrease your provisions?
PDD debit, income statement credit.
PDD debit, income statement credit. Okay, very well.
Hmm.
Can you all tell me one more thing? When I have to find out increase or decrease in the provisions, what formula do I apply?
Increase or decrease the
Then
provision.
you take the minus 10% of the net trade receivable, right?
Increase or decrease in the provisions, which is always calculated as a
Minus.
percentage of net trade receivables.
Yeah.
Okay, first,
Yeah.
so you calculate provisions as a percentage of your net trade receivables, right?
Yes.
But how do you calculate increase or decrease? How will you come to know whether your provisions are increasing or your provisions are decreasing?
Old minus new?
Old
If the
minus
answer is positive, if the answer is positive, then it's increasing. If the answer is negative, then it's decreasing.
if the
Or it's the other
answer
way
is
around.
positive, it is other income
Yeah.
and your
Okay.
provisions is decreasing.
Yeah, it's
If
the
your
other way
answer is negative, it is
around. Negative, then it's other expense and it's increasing.
and your provision is increasing. Are you with me?
Yeah.
Yes.
You can write simultaneously, like just scribble in your book if you all want to. Okay, so for increase or decrease in provisions, you are going to use old minus new. How about bad debts? When we have to record it in the income statement, what do we do?
If you have to record in the income statement.
You do old plus new. You just add both the
Okay.
bad debts together.
Okay.
Are you with me?
Yes.
Yeah.
Where do you get the old bad debts from?
From
The,
the
from the
trial balance.
Yes.
yeah,
So you will get your old bad debts from the trial balance. Where do you get the new bad debts from?
from
The
additional
adjustment.
information, like
Yeah, new bad debts you will get from additional information. Are you all with me?
Yeah.
yes.
Okay, fine. Now, tell me, what is the
Hmm.
difference between a revenue expenditure and capital expenditure?
Capital expenditure is a non-recurring expenditure.
What
It's
do you
not
mean
done
by it's a non-recurring expenditure?
I'm
It-
saying it's not done on daily basis. It's done very rarely, like once in a while. And revenue expenditure is a recurring expenditure, which means that it's done on a day-to-day basis. Uh,
What else
and
can come in revenue expenditure?
like
Rent,
rent, salary,
vacation,
maintenance.
Okay,
repairs.
repairs. So anything that happens more than once in a year, it happens
Yeah.
on a day-to-day basis. It has maintenance involved. It is a revenue expenditure. So what is the difference between a revenue expenditure and capital expenditure? Why do we differentiate whether your expense is a revenue expenditure or a capital expenditure?
Because mostly capital expenditure is done when you purchase non-current assets. So the revenue expenditure goes in the income statement and the capital expenditure will go in balance sheet.
In the statement of financial position.
Yeah,
So
statement of financial.
if there is something that happens when you treat revenue expenditure as capital expenditure or vice versa, which is the error that you're committing?
Principal.
So you're committing an error of principle. When do I say I have made an error of principle?
When revenue expenditure is treated as capital expenditure.
Okay. What is the effect if you treat a revenue expenditure as capital expenditure?
Your
Assets and profits are
Assets is
understated and
understated.
expenses overstated.
So if you treat your revenue expenditure as capital expenditure, what will happen, you said?
Assets will so assets income statement item would be wait, let me think.
When you treat your
So in the
revenue expenditure as capital expenditure, what will happen?
items in the income statement like assets, profits and expense will be put to balance
Is
sheet.
assets in the income statement?
No, it's not. Yeah, it's not. It's not.
When you're treating your revenue expenditure as capital expenditure, the items of the income statement are put in the balance sheet. Are you with me?
Okay. Okay. Okay.
What will happen if you treat items of your income statement as an item of your balance sheet?
Your profit will be your profit for the year will be overstated.
Let's talk
And
about assets first.
so
You
your
did a
asset,
revenue expenditure and you treated it as a capital expenditure. That means you treated your expense as your asset. You have done an expense and you treated it as an asset. What will happen? What will happen to your assets?
Assets would be overstated.
Yes, you have treated your expense as an asset, so assets will be overstated and expense will be
Understated.
understated because you did an expense but you did not treat it as an expense. So the expense
Yeah.
will be understated. What will happen to the profits?
Profit would also be overstated.
If expense is understated, your profits will
profits will
automatically be
be,
overstated. Are you
Yeah.
with me?
yeah.
Okay, fine. This is happening when you're treating your revenue expenditure as capital expenditure. Now tell me what happens if you treat your capital expenditure as revenue expenditure.
Yeah.
Your assets are treated as an expense, no?
Hmm.
Hmm. So it's gonna be like the items of the balance sheet we put into income statement then.
Yes.
So
So balance sheet items will be less, right? So asset will be understated.
Assets will be understated. How about
uh,
expense?
And since you're putting
then
the capital expense in the revenue expense, that means the other expense column will be more, so expense would be overstated.
And profits?
Profit would be
if
overstated.
yeah, because assets are understated, so profit will also be understated.
No. Because expense is overstated, you are having more expense, your profits will automatically be understated.
Okay.
Are you with me?
Yes,
Yeah.
miss.
Yes. Come on, let's talk about capital receipts and revenue receipts. What is a capital receipt?
Capital receipt is when you receive income, income that is not recurring in nature, so it doesn't happen on a daily basis. And revenue receipt is when you receive income on a daily basis. It's like salary or wages, commission,
You receive
capital receipt.
salary.
Yeah, you receive salary.
So
Sales.
talk about things that
Oh,
is
sale.
normal, okay? That normally happens. Like you can do sales. Sales is happening on a daily basis. It's a normal
Rent,
trading activity. What else?
rent receivable.
Commission received, discount received. So it's a revenue receipt. Can you tell me where does the revenue receipt appear?
Other income in the income statement.
Okay. Now what is a capital receipt?
Sale of asset, like any machinery that you sell or any furniture that you sell.
Capital.
As a
Capital
capital
receipt. So something that is not happening on a normal basis. It is not your normal trading activity, but you're receiving money. So these are the common examples of capital receipts. What is capital receipts? Tell me.
Money brought into the business, money received through bank loan, income from sale of fixed assets limited to book value of asset.
Okay. Now, what will happen if you treat your capital receipts as revenue receipts? Capital receipts is basically your liability.
So wait, miss, liability would be treated as an income.
Yeah.
Liability would be overstated.
You're
Yeah.
not treating the liability as a liability. You're treating
Okay,
it
so
as an
liability would be okay, so your liability would be understated, profits would and income would both of them would be overstated.
income would be overstated and profits would be overstated.
Yeah,
Okay.
no.
Okay, what will happen if you treat your revenue receipts as a capital receipt?
It's
Then
gonna be
liability.
income is treated as liability.
Income is treated as liability. That means income is
So
understated,
yeah, and profit is understated and liability is overstated.
Overstated.
profits is understated, And liability is overstated.
Overstated.
Are you with me?
Yeah.
Yes.
Let's go to accounting concepts and principles. First, we're talking about accounting principles. So, what are the 4 accounting principles?
Comparability, reliability, relevance, and
Comparability.
understandability.
Okay, what comes in comparability?
When you
Eh,
can compare you can compare it with another period or with other businesses.
Okay, so when you are comparing your financial statements with other people's financial statements or your 1 year income statement with other year's income statement, you're using comparability. When do you say it's reliable?
When there is no error, it's free from errors.
when the
Relevant.
information is
Relevant is when it affects the business decision in the future.
Understandability.
when it can be understood by everyone.
When it is
Capable of being
capable of being
Understood by
understood. Okay, now let's talk about the money measurement concept. What is money measurement concept?
when the you only write down the transactions that can be written in the monetary value.
So
Sorry?
basically,
Yeah.
You
you
only
record the transaction based on like the monetary terms, only transaction related to money.
Okay. So when you record only transactions related to money, it is which concept?
Monetary
money
concept.
measurement
Money
concept.
measurement concept. Are you with me?
Yeah.
Yes,
Now let's
miss.
talk about business entity concept. What is the business entity concept?
That the
that the
business should
business
only
and the
record
owner have a separate
Business
legal.
is treated separate from the owners. Business separate, owners separate. You do not record the owner's private transactions in your book.
Hmm.
Yeah.
Like
Let's
for
go.
example, if the owner takes some assets for himself, so you should not record it, right?
If he's taking the assets from the business, I will record
Yeah.
it as drawings. But if he's
Okay.
taking anything from his own money, I will not
On his
record
own money.
anything in my business books.
Okay. On his own money. All right.
Okay, what is historic cost concept?
that all the transactions are supposed to be recorded to the cost.
Okay, so if you have bought an asset worth 100,000 for 50,000,
Okay. For
so
50,000.
you will record it in your statement of financial position at what price?
100,000.
50,000. Could you say again, miss?
50,000.
Yeah, 50,000. Yeah.
Because what is happening is that for you, the amount that you spend to buy that asset is 50,000.
Oh,
So you will record it at the cost paid. Though its
Okay.
market value may be higher, it does not make any difference to you.
okay, fine.
So when you're following the historic cost concept, you're recording your assets in your financial statements at what price?
Cost.
Cost.
The
What is
cost
the
price.
what is the realization concept?
When
That
you record the transaction when it actually happens.
like
No.
credit sales, like purchases, like you do not record it until you get the money from the debtor, or you do not record it until you pay
So
the
you will not
creditor the
record
money.
credit sales?
Miss, wait. I think you'll record it in this the account, but you won't put it in the cash book unless you've received it.
So
Credit sales.
realization concept is basically telling you that you, unless and until you do not realize your profits, or you do not realize that the transaction has happened, you do not record it. Like supposing if a customer is walking into your shop and is telling you to just keep aside the goods, you will not consider it as sales.
Oh.
Sales will happen only when the ownership is transferred. Okay. So until and unless the ownership is not transferred, you cannot record it as sales. It does not matter whether you get the profits immediately or you get the money immediately or not. Okay. Unless and until the exchange of goods does not happen, you do not consider it as sales. Are you with me?
Yeah.
What is the
Yes,
dual
no.
aspect concept?
That every transaction has two effects, one debit and one credit.
Duality. It is also called as the concept of duality. The concept of duality tells you that all the transactions has two effects. One is the debit effect and one is the credit effect.
Yeah, okay.
What is the consistency concept?
That if a business, like for example, if a business is depreciating an asset by RBM, it should continue depreciating the assets by RBM and not switch to the straight line method until and unless they have a proper reason to do that.
What
Okay.
do you mean by RBM? Rate before month?
Recent
Consistency concept tells you that if you're following any procedure or any way to record your transactions or to treat your expenses, you should continue to consistently follow that concept. Okay? And you should not keep on changing your methods of recording something. Whatever you're doing, consistently do it. Unless and until the change that you're doing is giving a better representation. Okay, you should have valid reason to change your methods. What is materiality concept?
When you should not waste your time recording anything that has small amount of money.
Okay, don't
Like
waste your time.
basically petty cashes.
Sorry,
Basically like petty transactions, right?
petty transactions is still recorded in the petty cash book. But when I'm talking
Yeah.
about materiality concept, if you have a business of 100 million crores, you are not going to waste your time to record something which is of $5.
Yeah, that's true.
Okay, so but you should be very careful in deciding what is material and what is not material. If you have a business of $100, for you $5 will be material.
Yeah, and like 5 cents would not be material.
Even 5 cents would be, because your
Okay.
business turnover is very less.
Yeah,
What
okay.
is the matching concept?
The trading on the profit and loss account should only include the income earned and the expense incurred for the current financial year.
Matching concepts tells you that income for the year should be compared with the expense for the year to get the profit for the year. You should match. What you should do? You should match income for the year with the expense for the year to get profit for the year. Matching or accrual.
Okay.
What does the prudence concept tell you?
That profits and assets should not be overstated.
Your assets should not be overstated. But what is the reason for your prudence concept?
That wait one sec. You're supposed to value the something NRV and cost. We're supposed to take it on the lower value.
Lower, yeah, you're supposed to take the NRV and cost me the lower value.
Prudence tells you that if you see any expenditure that is going to come and you feel that is going to give you a loss, then you should immediately record for that loss. You should be very prudent and very cautious in showing your profits. Do not overstate your profits, do not overstate your assets. If you feel that you have any possible loss coming your way, then what you should do?
Record it.
Record first. But do not record income unless earned. What does prudence say?
Record any liabilities that you think
No,
that are
record
like
any expenses that you think will happen in future.
Yeah, okay. And
Record
don't
expenses even if you have doubt.
yeah,
Record expenses even if you have doubts.
doubts.
But do not record
Income.
income unless earned.
Yes.
Are you with me?
Okay, yeah.
Okay. Why do we do not record income unless earned? Which concept says us this?
Prudence.
Prudence tells that if you
income-
have any expense that is coming your way,
Okay.
you feel it recorded. Because
Realization.
of which we record bad debts, provision
yeah,
for
yeah,
bad
yeah.
debts.
Yeah, okay.
But But do not record income unless earned. Which concept tells you this?
Realization.
Realization. Okay. Then there is one thing which is called as the going concern assumption. Do you know about it?
No.
Going concern assumption is telling you that whenever you're recording anything in your financial statements, you assume that the business is going to continue for the future, continue for years and years. What is the going concern assumption?
Assume the business going for years and years. Miss, I still
You
don't understand
assume
it.
that the business is going for years and years. Now come on, 2 minutes time. Give me all the accounting concepts.
Reliability, understandability,
That's principles.
Concepts. Business entity, money measurement.
Money
Fine.
measurement,
Business
business
entity
entity,
concept.
money
What is
measurement
business
concept.
entity?
Business entity is when the business should have a separate identity from the owner.
So business entity, business separate, owner separate. Then which other?
Money measurement is when only transactions that can be expressed in monetary terms can be recorded.
Next.
Third would be
Anything.
realization.
Okay,
Realization. This is when you should only record something when it actually happens.
Prudence. Prudence concept.
What
But
does
that's
prudence
like
tell you?
expense should be like treated if you, even though you have doubt that's gonna come your way or not.
Okay, because of this, what entries do we pass for? Because of this, we pass entries for provision for doubtful debts.
Yeah, provision for doubtful debts, bad debts.
And because of this, we do inventory valuation.
Okay.
How do you value your inventory?
Net realizable value or cost, whichever is lower.
Lower of cost or net realizable value. When you find out costs, what is the thing that you add into it?
What, miss? Could you repeat the question
When
again?
you find out cost, you will add the carriage inward to it. And you find out net realizable value, you will deduct the selling expenses.
Okay.
Okay?
Yeah.
Come on. Next, what else you'll remember?
Fifth concept. Accrual? Accrual? Okay.
What does it say?
Accrual is when you include the income earned and the
Match
expenses spent.
income for the year with
Expenses for the
year.
So you match the income for the year with expense for the year. For what?
Yes.
To get what?
Profit.
To get profit for the year. To get what?
Profit for the year.
What are the concepts?
There are how many concepts are there in total?
10.
10, okay.
Consistency.
Historic.
Consistency. What does consistency tell?
When you have to follow only one, like how do I explain it?
When you're doing something consistently, keep on doing it.
Yeah, keeping
with the same method. And
use
only
the
change.
same thing.
Yeah.
Use the same methods.
Yeah. Until you have like a better method.
Don't
and a
keep
good
on
reason.
changing.
Yeah, okay.
What else?
Historic.
Historic cost concept. What does it say?
It says like to use
cost.
Record your transactions in the statement of financial position at cost paid.
Yeah.
What else? Can you see the screen over there? What can you see on the screen?
You writing stuff.
Sorry?
The Excel.
Okay, the Excel. Materiality.
Mr.
Yeah,
Also.
Mr. Yeah.
Mhm.
Record only material items.
Yeah, record only
What's one
material
more,
items.
not the compare one where you no, that's
Comparable? No, that's something else.
that's
What else? Come on, which other thing? Going
Uh,
concern.
yeah, going concern.
yeah, going
What does
concern.
going concern say?
Like we should presume that the business was going on for years.
You assume, while recording transaction, you assume that the business
Businesses
will keep on going,
for years.
for years and years. Are you with me?
Yes.
Okay, next, division of ledger. Tell me your ledger is divided into how many parts?
3 parts, miss.
No.
Purchase, 4 parts actually, sorry.
What are the 4 parts?
Sales ledger, purchase ledger, nominal ledger, cash book.
What does the sales ledger record?
All the personal accounts for all your credit customers.
All the credit customers.
So you record the personal account of all your credit customer. If A is your
Yes.
customer, you sold goods to
Yes.
A. A's account
Yes.
will be coming in which ledger?
Sales ledger.
Sales ledger.
And sales account will go in which ledger?
Sales account. Wait. Let me think.
Sales.
If
No,
A's
sales
account
ledger
will
is.
come in sales ledger, sales
Mhm.
account will come in which ledger?
Nominal ledger.
Nominal ledger. Very good. Nominal
Wait,
ledger records what?
all assets and gains.
All
Yes.
expense, loss,
Loss,
income,
income
gain.
and gain.
What
Alright.
does the
Yeah.
nominal ledger record?
All expense, loss,
Loss,
income and
income and
gain.
gains.
Can you give me some examples of things that comes in the nominal ledger, some accounts?
Uh, Bad debts.
Okay, what
Purchase.
else?
Depreciation.
Yeah,
Yes, what?
depreciation. Sales.
Rent.
Rent,
Purchase.
purchase, sales return, purchase return.
Yeah.
Okay. Okay, tell me what you record in your sales ledger.
All your personal accounts of all your credit customers.
What you record in purchase ledger.
Purchase ledger, all your credit suppliers.
Personal account of the credit suppliers. Remember, in
Yeah.
sales ledger or purchase ledger, you will always have names, or you will have trade receivables, trade payables,
Or
creditors, or debtors. Are you with me?
yes.
Can you tell me trade receivable comes in which ledger?
Trade receivable will come in
Sales ledger.
Trade payables will come in which ledger?
purchase ledger.
Creditors will come in which ledger?
Creditors will come in purchase ledger.
Purchase ledger.
Debtors will come in which ledger?
Sales
Sales
ledger.
ledger.
All your cash transactions are recorded in which book?
Cash book.
Okay, cash book is also a part of your double entry system. This you should remember.
Yeah, okay.
Okay, so can you all give me 4 ledgers? Ledgers are divided into 4 parts. What is it?
Sales ledger, purchase ledger, general ledger, and the cash book.
Okay, in sales ledger, what do you record?
In sales ledger, you record the names of all your credit customers.
Purchase ledger,
The names of all your suppliers,
credit
suppliers.
supplies. Cash book,
All cash transactions, and it's
it is
part of the
also a part of.
double entry
Double
bookkeeping
entry
system.
book system.
What do you record in nominal ledger?
All
All the
expense, loss,
expenses,
income and
losses,
gain.
income and gains.
You have 7 books of prime entry. What are they?
Cash book, petty
Cash
cash
book,
book,
petty cash book, sales
return,
book, sales return book, purchase book, purchase return book, general
and
journal.
general journal.
Cash book is also a journal as well as a.
Ledger.
It is a part of
The double entry system.
bookkeeping system. What do you record in the petty cash book?
All the petty transactions, like all the
Small
Small
transactions related to cash.
Okay, fine. Sales day book,
all the sale transactions of credit customers.
credit sales.
Credit sales.
Sales return,
Sales
Credit
return.
sales return.
purchase day book,
Purchase credit purchases.
Credit purchases.
purchase return book,
Purchase returns.
Purchase return.
general journal, all the
Extra items. Credit purchase of assets and debts.
Okay, fine. Division of ledger is correct, right? You know about it.
Yeah. Yes.
Okay. How do you prepare a trial balance and what is the reason to prepare a trial balance?
To reduce like the errors you get.
You prepare a trial balance to reduce errors?
I mean, if there's like any errors, you remake it, right?
No.
To check
What-
the arithmetical accuracy of the double entry bookkeeping system.
Okay, so what is basically there in your trial balance? What is a trial
You have
balance?
It specifies what is debit and what is credit. What items are debit and what items are credit.
So it's a list of the balances of the accounts at the end of the day.
Yeah.
Yes.
Okay, so it is the list of balances of accounts. So can you tell me when I'm recording something on the debit side, what are the things that will come on the debit of the trial balance?
Sales return, purchase.
Yes.
Hmm.
Bad debts, trade receivables.
Okay, so we identify it with a formula, right? All the spades will come on which side?
Oh yeah, debit side.
Debit, and all the clips will come on the
Credit side.
Credit side.
credit. What is the spades?
Sales return, purchase, assets, drawings, and expenses.
And clips?
Capital, liabilities, incomes, purchase returns, and sales.
You need to memorize all of this, huh? There is no option for you. What is impressed?
Oh shit.
Just impressed is the